Hey, look at the graph. I just shared a document with you. See the first page. The stock is down, so the next move is it's going to go up, all the way up. Look at the slide number 2. Look at the graphs of all these shares. 6 months it stayed up, and for the next 6 months it stayed down. For the last 3 years in a row. Let's buy these at a dip. These are cyclical stocks. It'll stay up, it'll go down, it'll stay up, it'll go down, it'll go up again. Look at slide number 3. Did you see that? This is one of the largest companies or the corporate houses in India. Look at the stock price. It's at its very, very bottom. This is an opportunity. Let's buy it. What do you think? Isn't it? You said no? Why? Seriously? Psychological bias. The tendency to take a decision or an action in an unknowingly irrational way. See, there are 2 different ways in which you can understand this world and what's happening around you. You lay out hypotheses, and then you find out evidences or test the authenticity. You gather data and theories about facts and figures and places. We derive a conclusion based on real studies and facts and proofs. Or the second option would be you use your everyday experience to test out different theories, and then you develop a notion about this world. In the stock market context, many do the same thing. When we're new in the market, we are just beginning to study the market and understand what it is, what it has to offer us. As a newcomer, we try to develop theories about the market, of what it has actually offered us and how we perceive it, how we look at it. Now this is where we get caught. Now since we did not conduct any tests or any experiments, we fall prey to the psychological bias. See, in our last video we discussed about the false consensus effect, where we wanted our decision to be supported by our friends, our relatives, our colleagues. We wanted them to say, yes, we wanted them to align their thoughts with my thoughts. But eventually they did not do it. If you haven't seen the video, I'll give it in the I button. Go and see it. We explained how we thought what we are thinking on a given scenario, on a given situation, others will behave and react the same way. Does it make sense? I don't think it is. Not even a little bit. Because what happened is, it's my perception, not others' perception. Short-term trading is something very much similar to this. It's about what others are going to do. Will they buy? Will they sell? It's about anticipating what others are going to do. And then make a trade. But let me ask you, is it very easy to anticipate? No, it's not. Not at all. Look, for instance, the recent period between 2020 and 2022. What happened? Corona, the war, FII pulling out money, possible recession coming into 2023. So much negative, so many bad news. But did we pull out? Did we pull out our money? No, we did not. Of course, yeah, some would definitely book their profits. There will be some who would definitely sell. But on a vast majority of the scale, we did not bail out. The majority of the investments still stayed in the market. In fact, new people entered the market in this situation, in this scenario. Talking about FII, they hardly withdrew approximately around 10% of their investments. We also saw a massive rise in the demat account openings, new demat account openings. Isn't it surprising? People have entered the market instead of moving away from it. And they have entered in large numbers. 2.2 crore new demat accounts were opened last year, between April and November. This is as per the New Economic Survey 2022. So if you have been thinking that due to the pandemic, due to the negative activity, the war, the possible recession coming in, people are going to move out of the market, they would fear the scenario, they would fear the situation. The data doesn't show it. We are wrong then in that case, isn't it? If you thought so, you're wrong. Why did I state this example? It just goes to show that what people does in a given scenario, in a given situation, it's beyond your and my control. So since we know it's difficult to anticipate the market and how it's going to react and how it's going to behave, let's try and understand what the market does and why does it do what it does. See, we as humans, we all have a capacity to work and perform. For every individual, it's different. And if we go beyond that capacity, the ability to perform, it drops drastically. So how do we prevent ourselves from overdoing, from going beyond our capacity of work? We take the help of the rule of thumb. In our previous video, we discussed about the false consensus effect. This is one of the psychological bias, and it's one of those rule of thumbs that we very often use for our benefit. No matter what the situation is, how easy or how difficult it is, we almost always certainly miscalculate and get a number which doesn't agree with our way of thinking, which doesn't align their thoughts. The number of people who don't align their thoughts with my own thinking, with our own thinking. So what we do, you would know definitely, is we anchor our decision. We say, okay, this is it. And we base our decision, we anchor our decision, and we find out people who agree to us. Now, the more we anchor our decision and try and find out people who agree with us, and we don't find them, this anchor becomes stronger and stronger. We tend to hold on to our anchor and say, fine, I'm not getting people who are listening to me. This is it. This is what I do. I have done the research. I have done the thorough research. I am sure those people, they do not know what they're doing. They do not know what they're saying. That's why they are refuting my beliefs. I very slowly, very slowly start to develop an overconfidence. As a trader, you would consistently try to anticipate what the people are going to anticipate, how they will behave. You look at the data in front of you and anticipate and draw a conclusion out of it. But the reality is, the only perspective you go with the data that is in front of you is your own perspective. It's not the other's perspective. Sadly, your perspective may or may not be correct. So how do we defeat the false consensus effect? Be aware of it. That's the best possible solution that we can have. Being aware of its presence. Always remember, the information that you have available at hand can be imperfect. So if it is imperfect, then you can be wrong. Manage the risk. Be skeptical. And believe that you, being a human, you can be biased with your own decision. So don't beat yourself up. Understand and take it with your stride as it comes to you. Get yourself together, recalculate, and then redo it again. Sum up and take the next decision. That's all for today. Thank you for watching this video. Stay tuned, like and subscribe this channel, and I'll come back with more mindset videos and how you can overcome them to be successful in the stock market. Stay tuned. Have a nice day. Till then, SG signing off. Goodbye.